People thought that both of us were completely crazy at that point in time. There was no fund after Kedara had raised that fund. Well, maybe no first-time fund was ever raised. We had, I think, 3 perfect rosters. We had first-time fund, first-time team India. Something great situation to be in. So we quickly realized that we're not getting any capital. We ended up short a smaller fund than we anticipated. We were looking at 100 we ended up with 88 million. The problem in continuation vehicles is that you end up selling somebody down the river, which effectively means that an incoming fund wants a discount of 20-30%. We feel that, look, it's not appropriate for you to take that discount. If the continuation vehicle is from the same set of investors, I think you're aligned. But if it is not, then I feel that it is unfair to the existing investor. We have 12 companies in our portfolio in Fund 1. We've exited 2 fully, and we've exited 4 partly. One of the companies is listed already, so it's liquid. So the goal is for us to get to a 1x DPI sometime next quarter.
Thank you, Mahesh, for joining us today. I want to begin before private equity, before deals, before term sheets. Who shaped the way you see the world?
I grew up in a very small town, Kolar Gold Fields, north Bangalore. I can say tier 4, tier 5 town. So in many ways, I think you're like a frog in the well. And your outlook is actually shaped by people around you, right? The first influences were really my dad and my brother. My brother actually studied in a Tamil medium school in a village, and that sort of brings a different outlook to how you see the world. I was always very entrepreneurial. I had my own investment firm when I was in college. All my professors were my clients, if I can say. So I never had the opportunity to bunk college as a result, because they will know. So I had a sub-broking firm, mobilizing fixed deposits and all of that. So I think a lot of these experiences shape who you are as a person. But the biggest influence on professionalism, work ethic, I think came from Arthur Andersen. I spent 4.5 years with them. Lots of hard work, up till 2 a.m. every day. But the outlook to a work ethic, the ability to not take no for an answer, the quality of your output, how do you engage with clients, seeking perfection, I think a lot of those qualities came from Andersen.
How did you find your way to private equity, to Carlyle?
From a very young age, I was very clear I wanted to be in finance. Again, shaped by father, brother, everybody in the family. I think we have lots of chartered accountants. Towards the end of my tenure in Andersen, I had the opportunity to corporate finance, working closely with them. And then Ernst & Young happened. From there, my clients actually hired me to be part of the initial team that was setting up the investment banking team. But deep in my heart, I knew I wanted to be somewhere in the investing field. I had no clue what private equity was. I was not actively looking to move, but one thing led to the other, and a good friend of mine on the investment banking side recommended my name to someone at Carlyle. Things happened.
The reason I asked about Carlyle is because Carlyle is known for having one of the industry's most rigorous, process-driven investing cultures. You spent more than a decade there. How did that stint mold you as an investor?
The nuances of investing, I'm grateful to Carlyle. Very, very talented both in India as colleagues and Asia. I was initially a part of the Asia venture platform, and also being part of a global franchise, you had an opportunity to engage with so many others within the team. There was the annual employee retreat where you get to meet people. So there's a cross-pollination. There was the deals that we evaluated together along with either the US venture or the US growth team. I think a lot of how to come prepared, how to build an investment thesis, what you look for, the attention to detail while you do that, engagement with founders. I learned a lot during that tenure. In fact, till the time I'd left, we hadn't lost capital on any deal that we had invested. We had a great run. It was also an era where we saw multiple cycles. We saw the 2004 boom, when a number of firms raised capital. Then we saw the 2008 bust, the entire global financial crisis. first Fund 1 and Fund 2 inherited a bunch of companies, so we had to turn some of them around, work closely with them.
What kind of portfolio was that? What kind of companies did you have in the mix?
I had Sher Khan, I had Learning, I had FSS. Some did really well. Most of them did really well. And some I had to liquidate and make sure that you had to return capital. So I think the importance of fiduciary duty to your investors, working for your LPs, I think it was all ingrained during my tenure there. That you're the custodian of somebody else's capital, that you don't work for Carlyle but really for your LPs. All those are things that you carry along. I think we've imbibed that into the culture when we set up Amicus.
So in April 2015, Sunil and you decided to start Amicus. You told me something earlier, the last time that we met, that when funds become too big, they lose touch with founder. Was that a big trigger for you for Amicus?
We started by investing in Carlyle with $10 million, actually much smaller than that. And what really happened was that the firm also grew. When I joined the firm, it's a great franchise, wonderful time, the entire 11 years that I was there. But it was becoming an asset gatherer.
Right.
AUM was important for a number of reasons. And I think for a firm of that size, each fund was now going to be a couple of $1 billion or much larger. And when you get to that size, you don't have much to do on a relative basis. So I think the joy of working with founders was very exciting for us.
Okay.
The high of seeing founders grow, and hopefully you leave the companies in a better position than what you inherited in, I think was a big high for me. Similarly for Sunil, if you track his True North started out as a 20 crore fund in 2000 and it was almost 700-800 by Fund 4 and similar trajectory, right, doing minority investing to control deals. So I think we share the same philosophy. So we said that, look, we need to go back to doing deals where we can engage with the founder. I think there's a lot more fun. The space is also relatively vacant. And that's really how Amicus was born. So in that sense, we had a shared vision. We used to compete for deals early on, but we never had an opportunity to work together. But I think our philosophy on firm building, outlook, what we wanted as a firm, I think was the same.
So how did that happen? You were peers, you were competing for deals. At what point did you sort of meet, sit down, talk and realize that, hey, we should do this together?
Apart from competing, I won't say that we knew each other, but he had already made up his mind in 2014 that he will invest and harvest some parts of the private funds and then leave. So it was a very organic, amicable separation for him. The fact that I was planning to leave was not known, but a couple of investment banker friends knew about it, and one of them connected us. Vinod Kumar, who was at that point in time with Veda, he said that you guys are very much alike and should talk, and that's really how it happened.
Both of you come from large funds, so what did you have to unlearn from the big fund culture?
Carlyle was very decentralized as a firm relative to many other global firms. If you take Blackstone or Warburg or the others, they had one mother fund and then smaller funds around, or others asset strategies, but everything revolved around the main fund. But Carlyle had many regional funds. So in that sense, we had a fairly entrepreneurial team on the ground. So the regional teams had to make it work in many ways. I had a very supportive boss in Shankar. He gave me a lot of space. So I would say that there was very little to unlearn. In fact, we carried a lot of our institution building capabilities into the firm. I think that on day one, I can say it with a lot of pride and confidence that I don't think any firm would have been as institutional as we were.
The name Amicus, it's derived from, it means friend?
Yeah.
So investors don't usually choose emotional word.
The friend to stakeholders. I think we want to be seen as a friendly partner to our investors, to our employees, to our portfolio companies. I think each of us play different roles. You as a fund manager have a fiduciary duty to the fund to generate the best returns, to do what is right for the fund, for its investors. But spending 5 years with a founder, and we are not one of those quarterly investors that goes in a board call and asks some information. we are very, very involved. Sometimes you're there in a town or city, you then visit the founder, you get to know the family. I think that it just goes beyond saying a transaction relationship of us investing in your firm. And in that sense, once you build that bond and people know that what you're doing is good for the firm and that you're aligned, I think that it's easy to build that equation. You can have difficult conversation, but outcomes can be good. And I'll give you an example of that. We had an investment in a company called Quest Global, and way back in between 2003 and 2007, we had a
This is Carlyle.
The exit from that was based on some form of disagreement that we had with the founders.
Okay.
The founders said they want to go on a certain path. I won't get into the specifics of that. But they said, we'll buy you out. We said, no problem. So we had a handshake on a certain price. They bought us out. Did exceptionally well for anyone who bought it subsequently. So you can say that, we left a lot of money on the table. And then years later, when I set up the fund, one of the founders reached out to me and said, I'll take you. We also don't second guess founders. What we try and do is, if there's an operational matter, or we feel that we don't have the competence, even if we disagree, we will let the founder take his or her decision. But if there's a capital allocation decision, I think we will, because I feel that we are better capital allocators, or at least it's the feeling, right, as investors, that we know how to allocate capital better. Because I think we're sitting one level removed. We don't confront founders in large board meetings. We try and have that in a private forum. So I think there are different things that we do that are slightly different from many other firms. I think that shapes how people engage with us as well. One part of our investing philosophy is alignment of interest. So typically that means that we don't go into companies where the value creation happens from another business that you are not a part of. I think that is a misalignment from day one. We try and solve for some of these very early on. And once the founder understands that you're aligned with them and vice versa, it's easy to solve.
When you were raising Fund 1, what kind of LP conversations did you have at the time?
I think we were a little naive in how we went about our own entire fundraising process. We came together in April, then spent a couple of months trying to put the deck and all that. It's not that we had any soft commitments before we left, right? So it was a blue sky. And actually very few people thought that both of us were completely crazy at that point in time. There was no fund after Kedara had raised their fund, maybe. No first time fund was ever raised. We had, I think, 3 perfect crosses. We had first time fund, first time team India. So I think great situation to be in. So we quickly realized that we're not getting any capital in 2015 because most of the commitments were already made. By the time we hit the road with our deck and everything, it was summer. Europe was pretty much closed. US was going into closure. We realized that we're not even getting meetings, leave alone anything else. Everybody was on leave. And all allocations for 2015 were done. So effectively started fundraising in 2016. We were lucky that we actually got a couple of anchor investors. And the first fund was largely offshore institutional investors. Domestic pool was not even available at that point in time. It was not easy. I think we had interesting questions like, will people show you deals now that you're not at Carlyle? First question in everybody's mind is the risk of a GP breakup. Because first time funds, I think that's really what people worry about. But I think the grounding for both of us and large firms, relatively large firms, was pretty clear that we had a point to prove. We ended up short a smaller fund than we anticipated. We were looking at 120. We ended up with 88 million. I think also driven by a number of factors. We were slow in deploying capital. I think a couple of deals fell off after diligence for us. So first close to final close, people were watching our pace of deployment. They didn't want to come into a blind pool. So I think we struggled a little bit in that phase after first close. We were fortunate to get to a first close by December of 2016. Given that we ended up with a smaller than expected size, we actually go down to doing what I would call as late stage VC kind of deals. I think we were probably the smallest private equity fund at that point in time. Even venture funds were larger than us at that point. So it was an interesting phase. We had to navigate through actually many events. In 17, I think the demon, GST.
Then COVID.
So we paced our deployment carefully because if we don't do well in the first fund. There's no second fund.
Right.
So we took our time, and that became the conversation for fund 2 as well. A lot of people said, "Oh, you guys are too slow. Like you're not finding enough deals." We would see 1,000 deals a year. Right? Even now we see 1,000 deals a year. But for somebody on the outside, it looks like too slow. But yeah, I think we are hopefully well past all of that. Fund 1 is doing well.
During that time when you were raising the fund and you came across all these challenges, at any point did you think, let's go back to Carlyle?
No. We had a lot of offers. In fact, Carlyle reached out and there were a lot of people who said, we'll pick a stake in your firm, we'll seed you. Lots of offers to acquire us, to join and build a smaller fund for a larger franchise. But no, I think Sunil and I were very clear. This is it. There were frustrating moments, but I think we were determined. Right? So it's fun. One of the things that when we set out early on itself, we decided that maybe we'll enjoy the entire process, even if we were getting kicked around.
So between Fund 1 and Fund 2, a lot has changed in private equity in India. Today, if you're a first-time fund manager, it is still challenging, but it is not as challenging as what you described in terms of your experience. But from your vantage point, how would you read the changes in private equity, especially in the mid-market space, since you started?
Actually, the mid-market space has seen big changes. From 2015 to 2025, went on to become, with literally nobody in that space, to reasonably competitive, to back to the same situation. I don't know that that's a function of whether the space itself is not attractive, but a lot of them who are successful have gone on to raise much larger funds. And there are a lot of people who didn't do well, who have not been able to raise their subsequent fund. I think many things have changed. Domestic capital is a big driver, and I think that has allowed a lot more fund managers, first-time fund managers to come in. Family offices actually put a lot of funds into business, which is good in my view because it's good risk capital. As long as you return capital back to investors, I'm sure it will keep coming back. I think there's a lot of confluence of many things that allow people to bring in domestic capital. India was back in focus. The allocation to India increased because of this, at least in the last 4-5 years, because the IPO markets have been reasonably robust, allowing people to return capital back to LPs. The mid-market, like I said, is back to being a handful of people, which is good for us, which means that we can pick and choose the deals that we want. Hopefully the margin of safety is higher.
So in Fund 2, you kept the fundraising open longer to allow for domestic capital. Why was that important for you? And if you can give me a little bit of a comparison between Fund 1, Fund 2 in terms of the LP mix.
So Fund 1, we've always had concentrated investors. 6 investors made up 90% of our capital in Fund 1, and largely offshore institutional capital. Fund 2 is much larger, 215 million fund, but we also have, again, very large institutional investors here. May not be 90%, but a reasonable mix of people from India and outside India. We extended the fundraise period by 6 months to accommodate a couple of institutional investors in India. The reason we feel Indian institutional interest is important is because it does not change with global trends. Their mandate is to invest in India, is to invest in Indian companies. And I think getting that stability in the pool is important. And you are also not dealing with issues of rupee depreciation. Sometimes India can be in favor. India may go out of favor for global institutions. And you don't want to be hit by that. Also, there is an interesting trend where some of the global investors don't have India dedicated allocation, which means that they want to contribute capital to the regions which generate the best returns. And the vintage of 2016 to, I'd say, 22-23 saw venture do well. Venture was completely out of favor between 2012-15, but came back, which meant that from a risk reward perspective, people felt that venture was attractive. So capital gravitated towards that. And so the allocation to the, I'd say, mid-market private equity was missing from many of the institutions, global institutions. What that really meant was that since they didn't have dedicated allocation towards India, you would not be able to get some of those institutional investors in. And I think getting domestic capital solves for some parts of that. The second piece is many of the global institutions don't like to come in as first close investors, which Indian institutions don't mind. And what that really does is allows you to raise the fund, put some capital to work and go back. It becomes easier then because you're not investing at a blind pool. I feel that the domestic capital will only increase. If you can consistently deliver 20+% return to investors, I think that investors will stay with you for longer periods of time. I think the domestic investors are doing private equity a big favor.
Let's talk about portfolio construction. When you look at the Amicus portfolio, it's a range of companies. What is the underlying story you are trying to tell with this portfolio construction?
The companies themselves might not give you the story in itself. We invest in companies in the mid-market space. We invest once the business model is proven and we provide capital to scale. So effectively, the bet is really on growth and scalability of the businesses that we really invest in. So at the heart of how we think about our investing style is four pillars of our investing. The first one is what I call as capital efficient businesses. So how can I find businesses that are capital efficient, which means that they have good metrics, they're profitable or very close to profitability. The second one is category leadership. Quite important for us because this allows us to exit companies and hopefully generate alpha. Companies that can go on to become segment leaders or sub-segment leaders in the businesses that they really operate in. And I'll give you examples of the companies that we've invested in, right? Across the board, if you look at our companies, they are segment leaders or sub-segment leaders. If you take RenewBuy, for example, it's among the top 3 digital insurance broking firms. If you take WonderChef, it's among the top 4 or 5 kitchen appliances companies. It's grown at 2x the entire industry for the last 10 quarters. You take Berar, it's the largest two-wheeler financier in central India, largest which is Shiprocket. Awign was the number 1 platform for gig workers. Amicus, the largest aerospace manufacturing firm. They're the largest shop for titanium machining in whole of India and maybe even Asia. Right? So I think if you look at some of these companies, they're all segment leaders or sub-segment leaders. Why is that important? For many reasons. It allows us to actually, capital chases leaders, and with that capital you're able to build a moat, which means better metrics. You're able to outdistance some of the competitors. And when capital is chasing leaders, it also allows you to exit seamlessly. For example, Pickrr got bought out by Shiprocket, Awign got bought out by a Japanese firm. The third pillar is alignment of interest, right? Who we partner with, how secure or insecure he or she is. Will they treat us as a junior partner in the business? And is the value creation or wealth creation of our business that we invest in tied to the founder or vice versa, right? Fourth one is risk and governance. ESG is a single bucket for us. We feel that if a deal across the sectors that we invest in, which is at the base of how we think about it, it ticks all of these, then we will look to make that investment. And then you overlay this with the 5 sectors that we invest in, which is healthcare, consumer, tech, financial services, specialty manufacturing. The reason we choose these sectors is because there's secular growth in each of these. On a relative basis, capital efficient. And maybe with our round plus one more round of financing, we should be able to get to a liquidity event.
Your exit strategy is aligned with the investment strategy from day one.
Yes, we have to find 2 avenues of exit. You either do an IPO, you do a strategic sale, or the third one is you can sell it to another private equity fund. If we can't find 2 of the 3 that are very visible, we will not do it.
So these days you can also do continuation vehicles. What do you think about that?
That thought did cross our mind, but the problem in continuation vehicles is that you end up selling somebody down the river, which effectively means that an incoming fund wants a discount of 20-30%. We feel that, look, it's not appropriate for you to take that discount. If the continuation vehicle is from the same set of investors, I think you're aligned. But if it is not, then I feel that it is unfair to the existing investor who are backing you. So I think if you take our investor first philosophy, I feel that it goes against that. It's not to say that we will not do a continuation fund. Sometimes you're forced to do it because of extraneous reasons. But I think that voluntarily we will not go in and search for a continuation vehicle unless we're forced to go down a certain path, or that we do a continuation vehicle at fair market value or very close to that.
How is the portfolio construction in Fund 2 shaping up differently from Fund 1? I'm sure there are some differences this time around. You have a larger fund. Your check sizes are going to be slightly bigger.
Philosophically, not very different because the underlying philosophy is the same 4 pillars that we talked about. But the size of the companies are different. In Fund 1, you write smaller checks, start with maybe 3-4 million, go all the way to 7-8 million. Fund 2, we don't do anything less than 10-12 million to start with. Then we go all the way to 25 million. So the companies that can absorb that are quite different. We would have some companies that were not very profitable, or that were just barely profitable, or with some path to profitability. Fund 2, most likely we will not do companies that are not profitable. We look for much scaled up businesses.
So are you ahead of schedule in terms of deployment this time?
Actually, slightly behind.
Okay.
But I think we'll catch up. We saw a period in 23-24 where I think the public markets were running away and everybody wanted to list. And as usual, we lost a few deals to the public markets where some banker came in and said, doing this deal at X, we can get you 1.5x in the public markets, and founder flipped. So we've lost a few of those deals that way. I think maybe we're a quarter or two behind with 2 deals.
So how much of the fund is already deployed?
We are 35% deployed.
And you're comfortable with that?
We should have been maybe closer to 45, 50, maybe 4 or 5 months behind still. Fund 2, also we will have a lot more co-investments. In Fund 1, we did have co-investments, but given that there are much larger institutions, pretty much in now 3 of the 4 deals that we have done, we have offered co-invest. And I think that percentage or size of co-investment will get bigger and bigger.
Coming to exits, where are you on exits from Fund 1?
We have 12 companies in our portfolio in Fund 1. We've exited 2 fully, and we've exited 4 partly. One of the companies is listed already, so it's liquid. The second one will get listed. We did a pre-IPO round in that company a couple of weeks back. We should sell some into the IPO soon as well. We are at about a little over 40% capital return to our investors, DPI. Okay. With the listed asset, we should be closer to 47-48%. With this listing capital being returned, we'll be closer to 70 plus. When I say soon, December of 2025. So the goal is for us to get to a 1x DPI sometime next quarter.
Great. Thank you so much.
Thank you.